Thank you so much, Ankur, for joining us on this podcast at Dawdle.live. Just to give our audience an introduction about Ankur. Ankur is the co-founder and CEO of 91 Growth Lane, and he's helping Indian B2B brands transform into profitable and scalable businesses. The company partners with founders and leadership teams to build practical go-to-market and growth strategies, and his work spans right from startups to established traditional companies across multiple B2B industries. I welcome you, Ankur. Thank you so much for joining us.
Thank you for the great introduction, Rishi. It was pleasure coming on this podcast. Thank you.
Thank you so much, Ankur. You are doing a fabulous job. So I've got the first topic to discuss with you is that since in your career you have already worked very closely with startups from very early stages to growth stage companies as well. What are the most common mistakes, Ankur, that you see, growth mistakes that founders make between an idea stage to say a few $1 million in revenue? And how does your company 91 Growth Lane help them avoid these?
Okay, perfect. That's a good question. So, working closely with startups at my agency, 91 Growth Lane, the most common mistakes we found, rather I say a pattern we have seen across the founders is like they operate at 30,000 feet height, which is not even near to the ground reality because they think of scaling the business before getting the clarity. And the clarity part is super important because investors, even if they go for the investment round or they want to scale, they need to have the exact clarity what customers are liking in their product. And sometimes what happens, like they plan for $100 million ARR before even cracking the first 10 clients or first 20 clients who can pay them even $100. So when we help them, how we help them is like 91 Growth Lane, we slow them down in terms of scaling and fasten their clarity index and make their startups foundation super strong structurally, because if this foundation is not strong, definitely in a longer run they will not able to make good revenue, because investors are very choosy these days and even the customers are, they just wanted to have to see a product which can actually solve the problem for these customers, and investors are looking for that metrics only, like how you are helping your customers and what is that adoption rate. So that's how like we start helping with them. And this you can see across like early stage startups who are very like early, they don't make any revenue, like pre-revenue phase. And the startups who are actually making revenue in a like couple of $1 million as well, they still operating at a 30,000 square feet height, like 30,000 feet height, which is not a good like stage to be in, because you have to crack these customers first and get the product mature first, and that you can only develop when you have the basics correct and the structure is super strong, the foundation is strong. So yeah.
So you mean to say that they plan a lot, but they lack in execution, like?
Yeah, though they even do the execution part, but they do a lot of execution in terms of the product side because they're attached with the product a lot. Founders have the bias towards the product, but customers don't take their product the way they are taking them, because the perception of a customer is entirely different. They might not like the features that you're developing. Maybe out of 100, maybe they're only liking 2 or 3 features which exactly gives the outcome to them. So the outcome specific approach is missing, and more on the product specifications and explanation of those products to investors, and pitch decks are based on those investment ready things only. Like they just wanted to make the pitch decks and the features just to show to the investors, not exactly to solve the problem of the customers. So you have to build the outcome driven approach and the features based on that. So that's what is I see the missing part is execution is super, even if the execution is high, but the clear execution is not there, the direction is missing. What exactly they have to do, they are doing a lot of experimentation. We have also seen this like in one of our client, what I see like from a B2B space, that client is, and that person is executing super fast. He's entering new features and new industries super fast, then that they lack the data which is required to make the next set of version of the product. So the market is not adopting to the product, and that's how they lose the investment as well in the later stage. So I personally feel this, that you have to operate a like a 5 feet height or a 10 feet height rather than 30,000 feet height, and work closely with the customers, go on the regular sales calls or maybe interview the customer and try to understand what exactly they're liking, your product is getting into their daily routine or not, for the repetitive task that they want your product to get.
Yeah.
So the adoption is super important to their daily routine.
This is very rightly told, actually, Ankur, and this is the need. I think all these startup founders have to realize this. And now, we were reading about 91 Growth Lane, and we saw that you are doing a superb job. And you also position yourself as an accelerator, which is based on execution, not just advice. So
Right.
can you walk us through how you practically help founders design and implement a fast, repeatable growth engine?
Okay. So when it comes to the fast, so what we help is like, firstly, as we say, we develop the foundation first and the clarity part. That includes the ICP clarity, if they have the right ICP clarity or not, rather than focusing on three different ICPs, because a lot of founders when started working with us, they have multiple ICPs, like they want to serve the different personas. So we start with one ICP, one message, and one channel, and try to experiment around it first. So experimentation are like hundreds of experiments. You don't need to do hundreds. Like you don't have to like put the 100 darts and wait for what exactly hits. So you have to start with the right experimentation. So while working with 150 plus businesses till now, but we have seen like there is a pattern and in every industry, and there is few channels that work in every industry, because like in a B2B, maybe Google and Insta perform a little different than a D2C brand and a B2C brand. So we develop the channel strategy, ICP strategy, and the messaging strategy around that channel first, and experiment with three messaging on one ICP and one channel. So that's how we started experiment, and we wanted to like understand the data fast, because we have to find out like what exactly performing well. And out of three, we finalized like we finalize one clear winner, and based on that winner we iterate that messaging again, and to see what exactly working and customers are adopting to it and resonating with it or not. So that's how we work.
Yes. Got it. And we see, many, you have kind of, touched upon this point, I think in the first or second minute, is that we see many founders struggle to translate a product into a clear go-to-market strategy. So
Right.
how do you help startups build a GTM plan that's realistic, testable, and attractive to both customers as well as investors?
Right. So customers see different North Star metrics, and the investors see different metrics. So you have to like because you don't have to swam the customer with lot of features. Firstly, you have to understand this. So what we do is like develop the clear like one outcome. So okay, let me put it this way. There must be one pressing problem every persona has and your customers have. So you have to find out that pressing pain point, and you have to develop a clear messaging around it, and then you have to work on that particular outcome backed by the features that you are developing. So your features must develop based on that. Developing clear benefits is super important in your product instead of just features. So what separates a like fundable startup from struggling ones is like the real difference is just it's not just traction or the tech quality or the product quality. Successful startups show the control over growth. They must have the control over the growth rather than just randomness, because investors are looking for, from a investor standpoint, I'm telling you this now. So investors are looking for not hustlers these days. They're looking for a CEO mindset. They want like you act like a CEO, you know the in and outs of the market, and like you can control the growth. If you don't able to control the growth, you don't have the metrics ready, your numbers are not backed by logics, yeah, the growth numbers are not backed by logics, then definitely investors get put off. And they are also looking these days like 2x growth, maybe 100% or 150% growth year on year for a startup, because that's what separates you from a non-startup category, which is like traditional business. That's their success criteria. And if you are in a pre-revenue phase, then they are looking for the adaptability metrics, like how much the adaptability of your product is there, if customers are using your product or not, and what features they are utilizing, and how frequent they are using your product. So these are the metrics like these investors are looking, and we help them develop all these metrics, all these data points, so they have control over the market. So they can show them they are the CEOs, not just the hustlers, because the data is so much out there in the market these days that investors also know that the data is accurate or not, and they sense it. So we have to like work on the like first hand data. That's how you can achieve faster growth and customer adoption.
Yes. Just a question was coming to my mind. It's kind of, so what is the difference that you have seen while you're working with a startup and a traditional company?
Okay, so traditional companies are majorly on these traditional companies are majorly are working on a similar format, like they are not adopting to the things faster.
Hmm.
And they are even not looking for investment as well, because their growth strategy is entirely different. These traditional companies are like typically shoot for 25 to 30% growth year on year. But
Hmm.
for a startup, if 2x growth is not there. Definitely, we don't call it a startup because startups have higher adaptability. They have more what we call like they have adaptability plus the market that they're capturing and the early adapters that they're capturing. They cater to those category, and these people want to spend more when the product is actually fitting their need. So these startups, in terms of growth, yeah, startups are x or 3x growth year on year, and the traditional companies are looking for the 25-30% growth, and they're not looking for investments as well, more on the side of when we say for the expansion standpoint. They their approach is entirely different. And what we feel, these traditional businesses have like clear set of like basics, fundamentals that they've cracked, that the reason they are making revenue. And
Yes.
for the startups, they are still cracking those basics,
Hmm.
because most traditional businesses are profitable, whom like we have worked with. Even if they at a 2 CR revenue or a 5 CR revenue, they are still making 30-40% 30-40% profits.
Yes.
But these startups, even if they're making $1 million, maybe they're not making any profit. So that's the clear differentiator that we have seen, and they have to start making on the profits. And the one more interesting fact that I have just that clicked my mind is unit economics. These traditional businesses have cracked the unit economics very well. So they know like how much we have to spend, how much the acquisition cost is there, and we can't afford to like go beyond that number. But startups are spending more on the acquisition side
Hmm.
and the conversion side as well. But the traditional businesses are very specific about like we can only spend the limited amount of money and we need the acquisition in this amount only. And they work on the unit economics very well.
Because somewhere I also feel is that they have a cash in, cash out in their mind pretty clear.
Right, right. And these startups are thinking on the lines of life cycle, like customer life cycle, but traditional businesses are not looking towards that customer life cycle. They want the faster revenue.
Yes.
And these startups are looking like if we spend on acquisition 2x more, but
Hmm.
the customer life cycle is in the longer run is better, then we spend more. So that's a clear difference.
Now, Ankur, since you have been helping a lot of startups raise funds as well, so when it comes to fundraising, what differentiates a startup that successfully raises capital and those that keep on struggling? And how does 91 Growth Lane prepare founders to be truly investment ready?
Okay. So okay. So what we help is like irrespective of the like category of a business,
Hmm.
we work with a lot of B2B, B2C as well. Like we recently work with DeepTech as well. But the data point really matters a lot to investors. So if you want to be like investment ready and the startups who are struggling, so these startups, what I feel like, again, I'm circling back to the my first point, which I answered. Like they are not looking, investors are not looking for number of features you are developing and how soon you can achieve this product maturity.
Hmm.
They're looking for like if customers are actually interested in your product and the outcome that you're delivering to them, are they, is it like the real need or not? Are you solving a real pain point or not? And if you have data around it, if you can show that we are controlling and like we are controlling, we are not an hustler, we are an operator.
Yes.
So they trust you. You have to act like an operator, that you know the market very well, you know the demand of the market, and you know how to serve them. You know, like you have to show them like even if you are like not having customers
Hmm.
currently and you are very early, then you can record some interview videos or maybe some testimonials from the customers and some like kind of an interviews,
Hmm.
not exactly testimonial but kind of interviews. You can, if you can show them
Hmm.
that you have captured these data, and definitely they will like start considering you for the investment. You have to show these data points to them, like, and they consider adaptable adoption data,
Hmm.
they consider the customer pain point data if you have that, and if your product is on those lines. And okay, there are a couple of other factors as well, but I feel like they are still secondary, because if you are from a tier 1 college or not, and if you have a strong network or not in the same industry, that comes later. But even if a tier 1 college person
Hmm.
go without the data and the numbers that investors are looking for,
Hmm.
which is adoption rate, the North Star metric is that only, like
Hmm.
how customers are reacting to it, and if you have a good NPS score or not. And yeah, show them the control, like you have the clear narrative around the growth. So if you know all these things, you are a winning founder for them.
Yes. Ankur, do you remember, any story like of a startup or a traditional company? And if you could take us through the starting part, like where you joined them or you hold their hands and then you took them to a particular end.
Okay, so I started as a head of marketing and an initial core team member at Classplus, and that company is grew to like more than, I think 350 crore in revenue and in valuation more than
You
$700 million.
were telling that when you joined, it was just 2 lakhs or 1 lakh something.
Yeah,
Yeah.
they're barely making any revenue back then when I joined that company, and like very early stage, like I was a core team member when I joined them. And the early adoption in India market is very different in the edtech space because they are in a B2B edtech space, and what we see like they wanted to capture a lot of big names in the market,
Mm,
but to capture the big names like in a like Fitzy was like the target customer. Akash was a target customer, but they wanted some data as well. Initial customers also wanted some data, like how our software can solve their problem. So we capture other institutes which are very smaller, like in size, and we show those data like how they grew in 1 year. And we also like do the white labeling for these clients, like developing their apps and also we came up with that different kind of marketing strategy where we are reaching out to them
mm,
and showcasing them like how their apps look like in a non digital format. So we
mm,
did the offline marketing and we send them like clear uh, roadmap of how their apps looks like and how their brand is looking like on Google Play and Apple iStore, and how they can develop their own app in like in just 10,000 or 20,000 bucks. So that give them the confidence, these smaller coaching institutes and these centers, and then that data convinced for the bigger players in the market like Fitzy, Narayana, and other government exam preparation institutes as well. And we onboard almost everyone in the market. So in that 2 year of non-digital marketing way as well, because I'm talking about in 2015 and 2016. So we did it in a non-digital format as well, because digital marketing was only producing like leads, but the conversion was not there because we spend like we have a like very limited amount of budget as well, because we are not that funding amount in the account as well. So we start with this non traditional like
mm,
non digital way, in just normal traditional way, and we capture the initial traction from there. We then also get on a lot of interview calls, and even founders like
mm,
I like what I like most about these founders are they going to the sales call with the client every day. Like they planned, like even if they have to like walk in to institute without having a meeting scheduled before, they do that. So I went to these institutes with them, and we have these discussions with them, and we got a lot of data, and then when we put that data into
mm.
the investor deck, that makes sense to them. And then we raised like around $7 million, then again like $30 million, and then $70 million in series BC round. So that's how the things came into the picture for these startups and for Classplus as well. See, in similar format,
Mm.
but I've seen in other startups, like I work for a couple of other startups, which I see like they are failing in the market because they, back in 21, I worked with another startup, and that startup has a lot of funding, but still the founder is not fine to go on sales call. He has people, but the founder is lacking the reality check. That's where I feel like the company is failing, because founders are the decision makers. They are the think tanks of the company. But if they are away from the reality, if they don't have the exact data what customer is looking for, they definitely lose money, and in the longer run, the game as well.
Such a pertinent point. And thank you so much, Ankur, for sharing all these insights and the fabulous work that you guys are doing at 91 Growth Lane. We wish you all the best. And thank you so much for joining us on this small session. Thank you so much.
Perfect. Thanks, Rishikesh, for having us.